Hello everyone. Today we will be learning about financial decisions. Before this, we have already learnt about what is financial management and what is the major objective of financial management, in which we learned that financial management is related with optimum procurement as well as optimum utilization of funds with the objective to maximize the shareholders' wealth. And we also learned that shareholders' wealth can only be maximized when proper financial decisions are taken in any organization. Because if proper financial decisions are taken in the organization, that is going to increase the market price of the shares, and when the market price of the shares is going to increase, the return that is going to come to the shareholders, that will always be higher, and their net worth is going to increase, because proper financial decisions will always lead to value addition in shareholders wealth. And that is the main purpose or the objective of financial management. So the question arises, what is this financial decision? There are basically three types of financial decisions, which is also called financial management decisions, which is taken by the financial managers in the business organization. The first is the investment decision, second is the financing decision, and third is the dividend decision. So whenever the financial decision is taken, it should always be best investment decision, best financing decision, and best dividend per share to be paid out to the shareholders, so that always value addition takes place in the wealth of the shareholders, and the shareholders' wealth increases, and that is also going to put impact on the market price of the shares, and the market price of the shares is also going to rise. So one by one in detail we will be talking about all these three decisions, what are these three decisions and how these decisions are taken in any organization. So first of all, we will be talking about investment decision, the first decision. We have to understand that in an organization, always it happens that an organization can invest in more than one projects. There is always different alternatives which the organization has. And because the resources are scarce in every organization and they can be put to different uses, it is for the organization to decide in which project it wants to invest. Had there been no scarcity of resources, the management or the financial manager would not be taking this investment decision. Because there is always scarcity of resources, that is why there is need to find out the best project in which the investment should be done. And investment should always be done keeping in mind that return on investment is always greater than cost of investment. So out of the various proposals which is available for the organization should always select that project in which maximum return the organization can get. That means which is most profitable. It should go for always that project which is most profitable so that it can add value to shareholders' wealth. Now, what is investment decision? Investment decision basically relates with investing funds in different types of assets. In different assets. And these assets may be long term assets and it may be also short term. That is why always investment decisions is of two types: long term investment decision and short term investment decision. Now, long term investment decision means it is also termed as capital budgeting decisions. Just keep this in mind. Capital budgeting decisions. Long term investment means investment done for long term period. And if the investment is done for long term period, generally such type of investment is related with investment in fixed assets. That may be for replacement of assets, replacement of machinery, change of technology, or it may be for modernization, expansion, diversification, or it may be for opening new branch. That is why whenever long term investment decisions are taken for investment in fixed assets, always it involves huge cost. And if it involves huge cost, whether there is replacement of old machineries or there is change of technology or there is modernization, expansion, diversification, or there is opening of new branch, all these decisions which is taken in the organization, that will always involve huge investment. And if this huge cost is involved or huge investment is involved in long term investment decisions, because the fund is committed for long term period and it is expected that the returns are also going to come for long term period with such huge investments which is done today, and the future fortune of the business will always be good. With that expectation, this type of investment is done. And that is why this long term investment decision, it affects the size of assets, competitiveness, and profitability aspect in any business organization. And finally, we have to also understand that these decisions, they should be taken after proper calculation has been done. So very wisely this decision has to be taken, because these decisions are irrevocable or irreversible decisions, because the decisions involve huge cost. So if the decision is reversed, that will be huge loss to the business organization. That is why prudent decision has to be taken whenever long term investment decision is done in any organization after proper analysis. The second type of investment decision is short term investment decision. Short term investment decision means that type of investment decision which is taken, for which the funds, they are committed for short term period, for meeting short term requirements. Short term requirement means working capital requirement needs. Requirement needs, or current assets required, which may be broken up into cash, inventories, receivables, because always, whenever the business has to estimate about the working capital requirement needs or daily requirement needs of the business, it should be estimated keeping in mind that neither there should be excess nor there should be shortage of these working capital requirement needs. Because if there is funds excess funds means the funds which has been raised and it has been unutilized, then it is wastage of funds if it is unutilized. And if there is shortage of funds when needed, then it is always going to impact the working of the enterprise. So in case of short term investment decisions, proper estimation of working capital requirement need should be made by the organization, keeping in mind the liquidity and profitability quotient. There should be balance between liquidity and profitability. When we say liquidity, that means the liquid assets which should be maintained in the organization every time to meet the requirements of the business. But those liquid assets, current assets, they are considered as liquid assets. They have to be maintained, always estimating its requirement, so that neither be excess liquidity nor there should be shortage of liquidity in the organization, because always inverse relationship is between liquidity and profitability. If we are maintaining unnecessary liquidity, that means greater is the liquidity, less will be the profitability. If we have raised funds, that means we have blocked the funds, and that is going to impact the profitability quotient if the funds are not properly utilized. That is why there is need for proper management of working capital in case of short term investment decisions. So this was the general concept related with long term and short term investment decisions. In our next topic, we will be talking about the factors affecting long term and short term investment decisions. Till then,